Hi, I'm Greg Andrick, and this is the Business Freedom Conversation newsletter number 7. So, since it's a newsletter, I'm going to bring you some news. So, the National Federation of Independent Business, which surveys pretty much constantly, has come out with their June survey of small business owners. It's not a very positive report for the month of June. 20% of the members rate inflation as the number one problem. That's 4 points below April, but still, that's the biggest problem out there. The Better Business Conditions Index dropped 4 points to negative 54%. That means when you deduct the people that think it's going to be worse from the people that think it's going to be better, the number is minus 54. That's the lowest number in 48 years. 51% of businesses are responding that job openings can't be filled. That's 4 point higher than April. 72% of business owners are raising their prices. That's the highest in 48 years. Owners that expect real sales to increase decreased 3 points from an April total of negative 15, or I should say to a total in June of negative 15. That's lower than April, and it's very negative, one of the most negative uh, outlooks they've ever recorded. So, the theme of this newsletter is cut your taxes. That's important in an inflationary period because if you raise your prices, there's usually a lag between raising the price and having to pay for the higher price your vendors charge you, and then Uncle Sam takes a big slice out of that. So cut your taxes is a major theme. Taxes used to be the number one problem in the NFIB surveys until a year ago in March of 21, when not being able to fill jobs with qualified employees became number one. And then in April 12, on the April 12 survey, inflation became number one, followed by not being able to fill employed, followed by the long-term number one, taxes. So we're going to talk about taxes in this newsletter. So the areas we're going to talk about is reduce your taxable income by 20%. There's tools to do that. I'm bringing it up now because I talked to 4 business owners last week who had no idea what this was. Another thing that'll help you with inflation is you can write off 100% of your capital asset acquisitions. We're going to talk about that. Then there's the home office deduction. Another thing that I was surprised that people that own businesses didn't know about, and this came up in a conversation, so I briefly explained it. So I'm going to explain it to you and give you the basics. Then here's one that's a little more complicated, but extremely important because it pays big results: LIFO inventory. We'll talk about that too. And then the final item we're going to talk about is our next live stream, which is on July 13 at 12 p.m. Pacific. That's a Wednesday. So your business income that you get to reduce by 20% is called qualified business income, and the nickname is QBI. QBI, you just simply reduce your taxable income that comes from your business by 20%. That was in the tax bill in 2018. There's an income limit. If you're single, the limit is $164,900 and the maximum benefit is $7,915. If you're married, the income limit is $329,800 and the benefit 20%. This is off the rate book for 2022. The benefit to a married couple that has $329,800 of income, which is the maximum for your 20% reduction of income, is $15,831. But all is not lost if your income is above the single or the married maximum. If you're above that level, you're allowed to reduce your qualified business income, which is pretty much your taxable income from your business, by 50% of your W-2 payroll. And if you have a labor intensive business, it could be more than what the straight benefit is. It's not available to C Corps. It's not available for professionals. You should talk to your tax preparer about it. If you have any questions, you can reach out to me and I can explain it to you and point you in the right direction to make sure that you get it. Now, this one's been around a long time. Congress changes it all the time, but right now it's a great benefit. Section 179 depreciation. Write that down. It's very valuable. It's on tangible equipment, items that are purchased, not leased. Your net income is the maximum amount that you can deduct. It used to be, that's why there are all these SUVs driving around. It used to be you could write off your entire SUV if you said 50% or more of it was used in business. Not anymore. There's a limit of $11,160 a year for cars and trucks. But it must be, all these assets must be used at least 50% or more for business. It's limited to $1 million and phased out at $2.5 million. But again, it's Section 179 depreciation. It really lowers your tax bill when you buy something. It's a great advantage, and it is an inflation fighter. Here's when I was shocked to have a couple of people last week not know that this was available. Home office deduction. There's a simplified deduction of you're allowed to deduct $5 per square foot up to a maximum of 300 square feet, which gives you a $1,500 total, no questions asked. It's almost like the tangible gift to charity, that $500 thing you put on your tax return. They don't even question it anymore. Everybody puts that $500 on there that they gave stuff to Goodwill or Salvation Army or whatever your favorite charity is, and you get that little piece of paper. You get to write off $500. Well, this home office deduction isn't quite like that. There is a form for it, but it's no questions asked. You can go custom, and it used to be in the old days, if you went custom, you were looking for what's called a line item audit. You'd get a letter from the IRS. You'd have to troop down with all your paperwork and show them everything. And then you'd get dinged for penalties and whatnot because usually people couldn't make the custom one to hold up. But if you want to go custom, it has to be a dedicated space. You're limited to the income from a home office activity. If you have a side gig, you can only deduct the money you make on the side gig. You can't take it away or deduct it against your income from a day job. But on custom, look at all the things you can write off. And homes are expensive, particularly with all the prices going up. Mortgage, taxes, insurance, utilities, repairs, and depreciation. The depreciation alone for one room in your house could be a substantial benefit, but you have to ask yourself whether it's worth the hassle or not to maybe be examined. And like I said, in the old days, it was like putting a target on your back if you took a custom home office deduction. But I'll tell you that right now, the IRS is in complete disarray. They're having a brain drain. The older people are leaving. I think the average age of the employees in the IRS is over 50. And they haven't, like everybody else, they haven't been able to hire qualified people. So if you feel lucky or you want to go with the hassle, try that custom because the depreciation alone could be a really large benefit to you. But if you want to go the other direction, no questions asked, you get to do $1,500 a year. And I was surprised that I had several people last week that didn't know either one of these. So this one is a little more complicated. It's been around forever. It was super popular in the 70s and 80s because that was the last time we had high inflation. LIFO inventory. LIFO stands for last in, first out. It gives you a higher cost of goods sold, which means you're going to have lower taxes. Who doesn't like lower taxes? It may require a change in accounting, and that used to be really hard to get and a big hassle. But I think in the current state of affairs at the IRS, I've heard on one of my CPA information sources that they still haven't processed 4 million tax returns from April. So put in a change of accounting. This benefits those who sell tangible products, but maybe not. I was the controller of a company that supplied expert services and did it on a job cost basis. They could probably take advantage of this because you put it in a job cost bucket and you would be able to assign other costs to it. So even though you don't sell tangible products, there may be a way for you to come up with matching your higher costs with your higher revenue. And that's what LIFO is about. Where it came about in the old days is like grain farmers, you put grain in a big pile and you scoop from the top of the pile. So the last in was the first that went out. That's the origin of it 100 years ago, maybe longer. But this can benefit you now. So try it. So we're going to have another live stream on Wednesday, July 13 at 12 p.m. Pacific. We're going to talk about corporate culture, employee and candidate assessments, cut your taxes, sales methods, and the next live stream after that.